We really need to look at, from the shareholder's perspective, what's going on when the property gets a huge increase in commercial rental income and thereby eliminates the maintenance. Sure, it's great not to have to pay so much, but it also affects their pass-through deductions. Just to give you the background, properties in especially sought-after retail rental districts are experiencing huge increases in rental income on the commercial lease renewals. And we all know that the commercial rents tend to reduce the maintenance that the shareholders have to pay. So what was bad about this? Well, let's just put aside for a moment the corporate taxes that might be due on the perceived profit, because that sort of goes in with the pass-through deductions. But because a shareholder can only deduct on their return expenses that they pay, then when they pay less, they only can take less deductions. So shareholders are seeing that their deductions either are reduced or eliminated. We have to be concerned, again, that that expense allocation of doing it differently between the perceived profit and the pass-through deduction isn't questioned by the IRS. That issue still remains open. But realize that the pass-through deductions are generally 50% of the maintenance for a building that has no commercial space. So when the commercial rents are wiping out the maintenance that a shareholder has to pay, then they're reduced, the amount is only 50% deductible. Many shareholders want to pay less and still take the same deductions. So we really think that substantial thought needs to go into the decision as to how to communicate this situation to your shareholders, that they're getting the benefit of not having to pay so much, but they have to give something back and that they're not going to get the same deductions that they're used to. This way they could use it for their income tax planning. As a board member, you have a fiduciary responsibility to protect the corporation and your shareholders. And I think you should be concerned about the risks associated for utilizing any aggressive strategy. Here with the shareholders, it affects their personal returns as well as whether or not there's any issues going on the corporate level. We think it's really important that a well-informed board be required to make these substantial decisions.